Let's now get into private credit, and our next guest saying predicting rain doesn't count when it comes to his sector. So can investors really time the market? Well, Frank Danieli joining us now from MA Financial. Frank, good to catch up with you. And interesting, you see, you like that phrase, predicting the rain doesn't count. It's all about building the ark.
Yeah, that's right, Andrew. Look, I put out an investor letter this quarter, and we've just gone through a quarter end, and this one's titled Predicting Rain Doesn't Count. It's all about a quote often attributed to Warren Buffett, although I don't think there's any record he actually necessarily said it, but it's certainly a Buffettism in its nature. The idea is predicting rain doesn't count, building the ark does. How I think this is relevant for investors when they're thinking about credit, this is all about the defensive part of your portfolio, and so the idea here is not being able to invent a crystal ball and guess what's going to happen tomorrow, because that is truly unpredictable, and you do go through sometimes uncertain environments, you go through volatility. What you need to be able to do is to deliver consistent returns in a portfolio that can weather different storms. And that's the whole idea of what I think credit's all about. I think it's really misunderstood. The letter came about by virtue of a question that I had from a number of investors who basically said, hey, there's a potential trade war going on, what's going to happen now?
So I mean, overall though, you say investing in credit, it's not about picking the winners. No. It's not about predicting the future. It's about avoiding the losers.
Yeah, credit's about avoiding losers and not picking winners. It's a really different way of thinking versus equity. In equity, you want to find companies that can be long-term compounding growth for you. In credit, it's all about making sure that you just get paid. You are entitled contractually to your loan being paid back and to get interest along the way, and that's it. There's no more and there's no less. The whole idea is about consistency, and that means you have to think differently about that part of your portfolio, and as a manager of money, you have to think differently about the way you invest.
All right, so in other words, make sure it's secured and asset-backed. That's the fundamental.
Secured asset-backed, you want a really low chance that something's going to go wrong with that loan, but sometimes low probability events still happen, and when they do, you want the chance to be even lower that you're going to actually lose money, and that's really the idea. Just minimize the instance of loss, have a diversified portfolio, and be consistent through time.
So where are you seeing opportunities at the moment, particularly given what's playing out globally?
Yeah, it is interesting at the moment. I mean, there's a lot of volatility going out there, and that means that some types of borrowers could face stress. If you're a company in the US that relies on a global supply chain, and you have to buy inputs for your products from China, for example, you're going to have significant tariffs on potentially your inputs, and you could face margin pressures. There'll be other types of businesses that either might benefit in the environment or have pricing power, they can pass things on. So you've got to be pretty selective. We still really like asset-oriented lending, asset-backed lending, things where you've got real, tangible collateral that your loan is secured against and that are highly diversified. We think that's the place to be at the moment. They also benefit from a range of other tailwinds that are going on around the whole global economy, the banking sector pulling back in certain types of lending. So I'd sort of stick there, but look, there's winners and losers in all of this, and you just have to make sure that you're not exposed to the losers.
All right, what are we seeing that the private credit yield? When we talk about those spreads, how's it tracking at the moment?
Yeah, look, spreads, I think still you're seeing, if you look at the listed investment trust space, a good proxy for this, you're seeing yields in the 400 to 500 basis points over cash sort of level. I think a 400 basis point over cash premiums, that's about an 8% net return at the moment, paid consistently, paid in income. That's a pretty attractive place to be in this environment. And if that's the defensive part of your portfolio, if that can have the staying power to deliver you those returns, then on the other side, on the growth side, you can be selective and opportunistic participating in equities. I'd be more opportunistic participating in the equity side than the credit side. Try do credit where it just gives you consistency and ballast.
Regionally, are you liking Australia at the moment?
Yeah, I do like Australia at the moment, actually. I think that the Australian economy benefits from a number of things. One, we have the Australian dollar stabilizer effect. The fact that the currency does tend to decline as it has does make Australia a good place for people to purchase goods, purchase services, and to invest when times get a bit more volatile. We're in an interesting place because we have a relationship, a strong relationship with both of the world powers that are engulfed in this trade war at the moment. So it's a good place to invest. The economy's in a pretty healthy shape, and we've got the RBA certainly has room to move on interest rates if they need to support the economy, through this period.
Yeah, you once again, I know you're not a predictions, but increasing likelihood that we're going to see at least 2 or 3 more rate cuts this year. How does that alter your picture at all in terms of your investment?
No, it really doesn't. We try and avoid that short-term noise. I think one of the things we're focused more on around rates is a longer-term thematic of the great normalization of rates. We went from very, very low interest rate environment to a rapid increase in rates, and now it's going to normalize. I think the question is, where does it normalize? So we're probably more focused on that question. I do think those long-term normalized rates, if you just look at them on a very long-term basis, anywhere from 3.5% to 4% is probably where you're going to see that land, I think. So we just expect that to play out really over time.